exciting because you know, the beautiful thing we all know is that America is full of great individuals. You know, the founding fathers are people that came from wherever they come from to believe in plugging into the land and creating wealth. That's why this is a wealth building nation. However, sometimes in the midst of the system, you know, when we build our wealth, it's like, okay, how do we grow it? How do we make it grow? And I really believe investing in real estate is a good place to go. So it's going to be a lot of Q&A on this one. You know, so we really encourage audience participation because a lot of entrepreneurs out there that's going to use this to find ways to invest their real estate, you know, refinance their real estate. So let's get started. We're going to share some PowerPoint, and then we'll get things going. All right, let's put up the PowerPoint. All right, let's end the first one. So today we're going to talk about, again, a very dear subject, you know, how, you know, basically business, you're a business person, you're a contractor, even people on fixed income. I want to give light to the fact, because a lot of people coming up like, you know, I'm retired, I only have a fixed income, but I have pension, I have Social Security. You know, what can I do with my house? You know, my house is falling apart. What can I do? And this is what we're gonna kind of address it on a simple level for everybody. And then if we need to get into detail, obviously we will need a one-on-one for each case at that point. So you're a 1099, you're a business person, independent contractor. How can you finance real estate? Let's go to the next slide. Actually, did we miss the first slide, the one that introduced the presenters? There you go. All right, so kind of need to introduce ourselves. Okay, my name is Gary Nix with the Gary Nix team. If you hear us on radio or you see our flyers around, it's all good. I'm a broker associate, meaning I am a broker underneath a broker. Almost 20 years in the business, Compass certified and 72 sold certified. That's a new way of selling real estate, making money for sellers all day long. All right, and my co-speaker is Chris. Talk about yourself a little bit.
Okay, Chris Rivera from Cross Country Mortgage. I've been doing mortgage originations for about 30 years, and I've really been blessed to have helped so many families attain wealth here in America through buying homes. Worked with the Gary Nix team for, almost a decade plus, I think, Gary. It's been quite some time. And I'm just thrilled that you've asked me to speak to some of your clients and let them know of some of the programs that are out there designed to help people buy their first home, and some who are looking to move up and buy a bigger house, or maybe just even investments. So I look really forward to the conversation that we're about to have.
All right, next slide. Okay, I don't know if we missed. Okay, so let me just talk about a previous slide that you guys saw. This whole concept of what we're going to talk about comes from the book Think and Grow Rich. Okay, and of course, I'm sure a lot of people have read that book, Think and Grow Rich. And the reason for that is the only way you get to go from where you are to where you want to be is first you got to think it, right? You know, the good book says where there is no vision, people perish, or people cast out restraint. Meaning, if you don't have vision, you can't see what's possible. So first of all, you got to envision yourself that I want to do this, I want to do that. And I'm hoping part of your vision to growing your wealth is amassing some real estate, you know, moving from one real estate to another. I just put I'm putting up a duplex of mine in the market to sell, to go buy it somewhere else. It's all about that. You grow your wealth, one way or the other. Okay, so we want to make sure anybody, wherever you are, you don't cut yourself from the buying game. Don't think, oh, because I have there's this restriction on my finances, or this restriction on my way of life, then I am cut out. It's you just gotta seek first, right? Seek first and understand, and then things come to you. Which is why, again, I kind of put that book in the front, Think and Grow Rich, because if your mind is in it, things will happen. And hopefully today we can uncover some things that can happen in this process. Next slide. So we just got to be purposeful and put in a plan. I remember a gentleman that I knew. I helped him with looking for a house and buying a house, and he's a pastor at a church. And it's like, Gary, you got to come to my church. Come to my church. I'm like, I will come. I'll come. I'll come. And I keep telling him I'll come and come, and it's like, come on. So finally, one day he called me up, and I told him, I said, you know what? I'm going to put an intention to attending your church. And he paused for a second. He said, you know what? There's power in that. I can believe you, that you're going to do it. And sure enough, within 2 weeks, I went to make that visit. So it's been purposeful. Anytime we put, there is no try. If you say, I want to try to get into real estate, I want to try to buy a house, I wanted to buy investment, you don't commit your body into it. But once you put a purpose into, okay, I intend to do this, all of a sudden, boom, things start happening. Literally, it's like a veil is revealed, another veil is revealed. A open door comes up to you. You look through the window, all of a sudden you see something different. And but it's power and purposefulness. Next slide. All right, so Chris, if you can talk about what a credit score can do for people, that would be great.
Sure. So one of the many things that we do as mortgage brokers or mortgage bankers like myself is we're going to pull someone's credit score up front, and we're going to get all three major repositories. You've heard of Experian, TransUnion, Equifax, and we're going to go off your middle score to determine not only your interest rate, but also if you have to have mortgage insurance, what that mortgage insurance premium will be. So it's very important that you have the best credit score possible so that you can get the best terms in terms of interest rate and what you would have to pay on mortgage insurance. A lot of times people aren't really sure what their scores are. They believe it's good or fair. And the thing is, once they pull their credit report, they find that there's erroneous marks in the credit report. It's really important to pull it up front, just at least once, so you know what's there. And that way, if there's anything there, you can work on to get it into that excellent level. Because again, the higher the credit score, the better or excellent credit score that you have, the better interest rate you will get, as well as the lowest mortgage insurance premium that you will pay as well. So, the credit score is really important in the buying game. And even if you can't buy now, what we can do is show you what you can do to fix your credit so that you get on that path of home ownership. Kind of what you were talking about just a few minutes ago, Gary, about the vision and making that purpose for yourself. Don't feel that since you have poor or fair credit that you can't buy. Let us, as the experienced individuals, help you get there where you need for that credit score and income and save down payments so that you can become a homeowner.
Awesome. Thank you for sharing. Bottom line to say that we need to build that credit up. But I'm a big believer is wherever you are, you can get better. Again, I think we just had a seminar last month about how to get to 800 FICO score. So we're not going to talk about that today, but really important to understand that, it's really good for us to be conscious of it. We can't live a life of disregard for our credit. We really can't. You have to be conscious of it. And just a quick nutshell of that is don't have no late payments. At the very minimum, make your minimum payments. And then two, get your revolving credit down to 30% and under as soon as you can. And settle all collection before they become collections, because life happens, we deal with life, and just try and tackle it. And the one thing I always tell people, answer the call. If you get a call from Target, you get a call from Lowe's or Capital One, answer the call. There is no creditor that wants to mess you up. They really all want to work with us. We just think, oh, because I don't have that money, I can't answer the call. It should never be like that. You should always know that they will work with you. If you can't make the payment this month, tell them you're going to make it next month. They will probably not report you for being late. But if you don't answer the call, they're going to report it. All right, next slide. No, okay. It's so good. So don't just think about today. Always have a plan for you tomorrow. What do I mean by that? A lot of us will live where we make money. Whatever money we're making today will live there, right? I've been blessed to see people that make 40,000, 100,000, 250,000, doesn't matter. We all live where we are making that money. But the future is brighter when we invest in it, because, we may be good where we are today, but in the future is a lot brighter when we invest in it. I mean, I just, I was just talking to a young lady that helped her buy a duplex a couple of years ago, and now she's like frustrated with the tenants and blah blah, and like, oh, I don't know, I know you say I should get this thing, and I opened her eyes. I said, wait a minute, let's just take a look. You bought the property for 700. You can probably sell it for 950 today. Do you see how much wealth you built in 2.5 years? She's like, oh my God, you're right. So it's investing in our future. It's really important for us to plan that, because if we're just looking at today, yeah, we live our life what we're living today. We go on vacation, we want to go, blah blah. I remember I met this one couple a few years back, like, we don't, we go to Lakers game, we do this. So we don't want to mess with that to go say we're going to go buy a house. I said, really? I say, think about it this way. You've been going to the Lakers game for how long? They say for 5 years. I'm like, great. That's an investment in entertainment, which is great. I think we should all do that. But think about if 5 years ago, you also have made a decision to buy a property. Today, you'll be sitting on $300,000 worth of wealth. They're like, whoa. I say, just think about where you're living right now. Can we buy something in there? And that's what we have to think about. We have to see our future. It's not just for ourselves. If you're going to have children, if you're going to get married, you're going to have, as you grow up, your kids are going to grow up. What are you going to leave for them? So this is why we want to grow our wealth and not stay where we are. All right, next slide. All right, so we're going to talk about the things you need to consider. Again, we are talking about independent contractors. You're on 1099. You're on fixed income. Really, let's put those first two people together, right? If you're an independent contractor, you are making money. Maybe you own a business. You own a restaurant. Maybe you're in a transportation business. You're a Uber driver. You are an independent contractor. When you're like that, by the way, a realtor is an independent contractor, and it's a shame. When I meet realtors that they've been selling real estate for 10 years, they don't own a home. I'm like, oh my God, you're in the wrong place. So, but what we want to give you clarity to is today is that when you start filing your taxes and you have $150,000 in deposit and you want to write off 100,000 so you don't pay any tax, think about this. And I'm really hopeful that this is March 18th. Taxes are not due to April 17 or whatever that may be. This is where clarity makes us powerful. So we'll think about the property we want. Okay. Next slide. And the income it takes to qualify for that property. Okay, so this is where Chris is gonna come along. All right. So Chris, an average home in LA County right now is about 850,000. All right.
Okay.
So if we have no debt and we're buying FHA, that's the first time buyer low down payment requirement, right? So for $850,000 property, how much income do we need to show? Because what our mortgage is going to be, I don't know. Tell us what the mortgage will be. I know I'm kind of putting you on the spot, but just to give them an idea, because this is where clarity becomes powerful. If you're going to buy $850,000 home and you put in 3.5% down, what is going to be that payment? So whatever that payment is, Chris will let us know in a few minutes, but whatever that payment is, you need to double that income that you're going to show on your taxes. So if you're having a desire, like, okay, this $850,000 home is what I want, what income must I show? Now, I believe FHA, your what do you call it? Your front line is going to be, is it 45% or is it 50%?
47%. That's the math. 47.
Okay. So what would that payment be?
So roughly, I mean, there's a lot of factors that go into your interest rate, as we talked about credit score earlier. So I'm just going to assume someone's got an excellent score, but all inclusive of principal and interest, property taxes, insurance, you're looking at roughly $6,500 a month for a sale price of $800,000 using an FHA loan.
Okay. So at $6,500 a month, that's 47% of your gross income. I want you to be careful. We're not talking net income. Now, if you're an independent, okay, let me slow down on that. When you're an independent contractor, you are not paying any net because you're not paying taxes up front. At least you're not required to. You can pay it up front, which we do recommend. I'm sure most accountants recommend you pay quarterly taxes, so it's not heavy on you at the end of the year. However, so if you need to show $6,500 a month and it needs to be 47% of your income, what would that income need to be, Chris?
Roughly about $14,000 a month.
Okay. So this is where I want to give people clarity. Clarity gives us so much power, right? If you understand that, okay, I need to have 14,000 income in order for me to buy. So if because I've had people come to me that they make $250,000, but they write off their taxes where they're only showing $50,000 in income. That's no knowledge, or again, it's just living where you are, not having clarity about growing your wealth, right? So if you understand that, okay, I need to show 14,000, so you times 14 times 12, whatever that may be. My math is not that good. I'm sure most people are better in math here than I am. But you times 14 times 12, you're like, okay, that's the income I need to show if I want to buy that. Now, of course, you can buy something lesser or you can buy something more. It's just having clarity about that, that's the income I need to show. All right, let's go to the next slide. And create a world of that income, right? So whatever you want to buy, if you say, okay, I don't need a $850, maybe I buy a $700,000 property. Well, we'll check back with myself or even Chris. They will tell you, okay, this is the income you need to show, right? And you show that income, because most business people, it's not that they're not making the money, they are, Now, of course, if you just started a business, you're still a beginner, right? But if you're a seasoned business person, you are making the money. I've seen people come to me, a restaurant owner, that their income is close to $1 million, right? But they're showing $80,000 a year. And they've got $250,000, in savings. So it's all of that is possible. It's just knowing that, okay, this is the income I need to show. Let me go show that, so that way I can be able to have the life that I desire. All right, next. So this is the biggest thing. I mean, listen, I'm not blaming anybody. I remember our former president, President Trump, is still fighting over his taxes and not what. And even though he's a billionaire, right? Most people do not want to pay Uncle Sam taxes. I get it. I get it. I get it. Now, to be a good citizen, I think you should pay some level of tax. Okay, but let's talk about. I'm all for covering up anything you need to cover up, writing off everything you need to write off, but let's do it the right way, and let's be that focus. Like, okay, even if it's just for a couple of years, that okay, I want to buy a property, instead of me renting, let me show the income I need to show in order for me to be in a position to make the purchase. Again, we are in March, right before, and you have extension that you can do. So it's getting an understanding that, okay, if you let's keep with the $800,000 property, we'll talk about $14,000 in income. So we'll do that 14,000 times 12. That's $168,000. So if we have deposits into our business of 220,000, because like people have 280, sometimes people have $300,000 in deposits, right? So now we can write off some business expenses and keep it where the gross is 168. Now 168, you're gonna pay taxes. Now let me just give you guys clarity. This is why Chris is really here to help us out understand it. So you're gonna pay taxes on 168. Do you have a rough idea of what that would be, Chris?
Well, someone in that statute, you're probably paying about 30% for federal and state.
Okay, so 30% for federal and state. So 30%, let's see, times 30% is $50,000 in taxes. Whoa. It's a lot. I get it. But I want you to understand. Now, there is a first-time buyer program. Chris, tell us about it, because I want people to see. Now, normally when you buy a home, you need to put 20% down anyway. So the $800,000, you're supposed to put $160,000 down. But the government is giving you, if you're a first-time buyer, where you can do 3.5%. But more than that, the state also give you a program where they will pay that 3.5% for you. So the 3.5% on $800,000 home, that's $25,000. Well, the government will take care of that for you, right? So now, if you pay $50,000 in taxes, you are not putting 50 plus $25,000 down. You get that covered, so you can take advantage of that down payment. And so kind of can we take the slide off? Let's just hear Chris talk about, just talk real quickly about the CAL FHA financing, what it entails, and then we'll come back to the slide.
Got it. All right, so the state has got a program for first-time home buyers.
Can you take the slide off, please?
And it's designed to help home ownership here in the state of California. Now, it's been around for decades, but the thing that they've done over the last few years has really made it more consumer-friendly. They made tweaks to the program so that income limits are higher, and it also allows you then to purchase higher sale prices given the fact that real estate has gained in value over the last 3+ years. So the program itself, again, is for a first-time homebuyer who's someone who has not owned ownership interest in their primary residence in the last 3 years. That's the first thing you have to know. So you could have owned property in the past, sold it, and you haven't owned property in the last 3 years. You are designated as a first-time homebuyer, so you can get into this program. The beauty of the program is that it allows you to use funds from the state for the down payment. As Gary had mentioned, you can use an FHA loan, which is a government loan that requires a minimum down payment of 3.5%. So the state will give you that 3.5%. So you're going to have a first and a second. You'll have a first of 96.5% from the lender, and then a 3.5% second from the state. Now, the beauty of the state second is it's what we call a silent second. So there's no monthly payment ever made on that lien that they put on your property. It's just accruing interest, but at a simple interest rate. And I'll table that for a second. So as Gary mentioned, you bought something for $800,000. 3.5% is actually $28,000. So you get first trust deed from your lender of $772,000, and the state gives you the $28,000 for the down payment. Now, they do place a lien on your property. You make no monthly payment while you hold that note with the state. You pay them back whenever you sell the property, you refinance, or at the end of the 30-year term when your house is now free and clear, and you have to give back the monies to the state. But the state is not designed to really try to make money from you. What they're trying to do is help you obtain a home. So what they say is, hey, we're going to give you the $28,000 for your down payment, and all we're going to do is charge you simple interest of 1% per annum. So think about that. You just got $28,000 from the state. You only pay them back 1%, which is $280 for the year. That's right, $280 for the year. And if you put that on a monthly basis, it's roughly about $24 a month. And that's how you pay back the state. And you pay them back, again, whenever you sell, refinance, and or at the end of the 30-year term. And it's however many months that you carry the loan. And it's $24 per month for that many months, plus the original $28,000. But what it has done is it allowed you to use funds from the state to buy home and start that equity clock growing for you. Because Gary's right. You know, the thing is, the number one investment that you can make for yourself, besides investing in yourself, is really real estate. Because over the course of time, it's going to just grow. And before you know it, you're looking back 5 to 10 years on this mortgage that you thought was so tough to make, and you find out how to make it in the beginning, and all of a sudden it becomes very easy because you now have had it under your belt for 3+ years. But then you look back and you're sitting on, hundreds of thousands of dollars of equity. And that's real money. That's your monies that you've built for yourself for your future. So the state program, which is called CalHFA, will give you the down payment. Now it's just a matter of you qualifying for it. And again, it's very cheap because it's only 1% per annum that you're going to pay them back. And it's simple interest. It's not your normal loan. So what I find is people are able to get into their house. They hold a mortgage for a short period of time because, as you know, rates are kind of high. If we would have talked a year and a half ago, rates were at 3% and below. Rates will come back to us. They will come down. And when that happens, you're able to refinance. But you can't refinance into those low rates unless you own a home. So it's really important that you kind of put the cart before the horse, so to speak. I know it's very hard to do it, but if you think about it, you got to look at it from a global standpoint. If I buy a house today, and yes, the payment is higher than what I truly want because interest rates are high, you're going to be able to refinance that into a lower rate at some point in time in the future, and that will put you in a better cash flow position. It's a phrase that we use in the mortgage industry. It's marry the property, date the rate, and it's so true. You're going to fall in love with the house, and that's great because that's going to be the home that you're going to have for your family and raise your family and grow roots in the community. I get that. But the rate itself, you're only going to date it for a period of time because you're really going to wait until the rates become favorable for you, and then you're able to refinance into a lower monthly payment. So the program put on by the state, it's a great program because it's by the state. It's not a county program. It's not a city program that only has a certain amount of funds set aside for you. This is a state program. They have unlimited funds. It is there for you to take advantage so that you can become that homeowner. And the first step that you need to do is sit down with Gary and myself, find out what you guys can qualify for, utilize the funds from the state, and then purchase your home and get onto that home ownership path so you can start building equity. But the first step, again, is to meet with Gary or myself.
All right, thank you very much for that. Again, this is one of the many ways. It's just trying to let people know the taxes you pay is going to give you the power to make a purchase. So, and even if you just got to suffer it for that couple of years, now if you say no, I want to just do 1 year. So if they wanted to just do taxes for 1 year, is there a Fannie Mae program where they can put more money down and they just show 1 year taxes on it?
Oh yeah, I mean we've got hundreds of different loan programs, Gary. There's no one size fits all. So if there's any takeaway from what I say is, the first thing is you really got to sit down with Gary, myself, get a game plan, but let us see what you qualify for, because there's so many different programs out there. There's bank statement programs for people who are self-employed, who don't want to pay taxes. Maybe you go that route and show the deposits on your bank statements. There are 1 year tax return programs where, yeah, maybe you suck it up for 1 year and you have to pay the higher tax for that year, but your qualifying income is higher, which allows you to buy the house in the area that you want. There's so many different ways that you can go.
That's okay. I'm sorry, I don't want to cut you short on that, but I just want to make sure people see that even if you just want to do 1 year thing, right? Where, okay, I didn't, maybe last year in 2021, you reported 50,000. That's not going to get you anything. But 2022, like, okay, what do I need to show if I want to buy and I have the money? So you can do that 1 year and then put 10% down and buy anything you want to buy based on the income you create. Remember, I talk about creating the income. Look at the property you want to buy and then creating the income that's going to match that. If you're going to buy a $600,000 home, you don't need to create income that qualifies you for $1 million. But if you're going to buy $1 million home, you can create an income that's for 600,000. So it's having clarity on that and say, okay, this is what I want to take advantage of the first-time buyer program that the state is offering me. No, I got my own money. I'm going to put 10% or 20% down. What income do I need to show? It's a little bit different. And if you like President Trump, you don't want to pay your taxes at all, okay, they got a bank statement program for you. You just got to put more money down for that. So it's just finding what's available rather than shutting ourselves up on possibility. We still got a few more slides to go. And please, if you stay to the end, we're going to have a raffle drawing. We give $100 Costco card for gas, so gas is always something anybody can use right now. So
Gary,
yes.
Gary, I have one more question, or I wanted to say something about your the income itself, especially for self-employed people, because right now you're right. People are starting to gather their paperwork to file their taxes, and you'd be surprised that you're sometimes not very far off of qualifying for what you want. But right now you're kind of in that area where have us look at your tax returns before you file them. You can go ahead and get your tax returns done by your CPA or your accountant, but don't file them. Let us take a look at them, because maybe you can not have to have as many expenses, pay a little bit more in taxes. And it's not the entire amount, just a little bit more, because you don't claim as many expenses against your gross income, but it gets you to the qualifying. So it's really important right now for us to look at it before you file, because once you file, those are the tax returns we have to use for qualifying. So it would be important for you, go ahead and get them done. Know what they are, but don't file them. Have a lender look at them to make sure you qualify for what you want, and then go ahead and file.
Awesome. Awesome. Thank you for sharing. All right, next slide. Okay, just talk about that. The next one. So again, we want to make sure nobody cut themselves out on building their wealth. What's your wealth? It's your legacy, uh, your home, your investment, your future. It really is that. How do if somebody passed away today, uh, how you look at is what do they have, right? What do they have to pass on? And in most cases, people may have a life insurance policy, 200,000 or 500,000 life insurance policy. But in most cases, it's the home. I had a young lady a few years ago, her grandparents passed away. Uh, they left her a triplex in Hermosa Beach. It was worth $3 million. That young girl's life, she was 21. It changes from that point on, right? So it's what's your legacy that you leave behind, and a home is really where you can do that. And my thing is to encourage people not to just buy one, but buy multiple homes. I taught a class on how you build wealth, right? And telling people to envision what do you want to, even your retirement stage, how much do you want to live by? Don't plan on, I rent a house to an RN. This lady was an RN in her lifetime, and she worked as an RN for 35 years. And I rented her a house, and she was struggling because she doesn't want to collect, aid from Section 8 or whatnot. But she was struggling with making the payment. And I'm like, you an RN for 35 years, you live above the middle class for 35 years, but you didn't invest. Whereas I've had a young lady that was working at Albertson, making $44,000, and came to me and said, Gary, how do I build wealth to have 2 homes? And she got those 2 homes within 3 years. And today, those 2 homes are worth over 500,000. She's still making $44,000 to $48,000 a year, folks. It's all about what we see. Just don't cut yourself out of it. Your first one is your first one, but how do you grow with that? It's really the key. And I'm really proud. I don't want to mention this young lady's name. It's somebody that's been in some of my seminar, and she's like, "Okay, Gary, I got it. The first one I want to buy, I have my money for down payment, but I want the state to pay for my down payment." And we're just going to be closing on that on Monday. And she said, I've got my money. So now tell me, how can I buy my second one? I love that. I love that. Young lady, it's like, that's what I want. If I can get a lot of people to do that, oh my God. It's real estate is not about making money for me. It's really helping people to discover their wealth. Just imagine that kind of energy in this world, in this, whatever the rate is. She got it, like, okay. And she does have a down payment for the second one. I said, well, you can buy that quickly. Just hold up. All right, let's go. Let's get to the next slide. Okay, so we're gonna do case files. Now, while we're doing the case file, if anybody got any questions they want to ask, I want to give you guys some of these case files might cover that. It's just basically looking at some scenarios and seeing what are the possible hands. So Chris is going to be doing a lot of talking on this. All right, so let's go to case file number 1. Okay, so entertainer that generates about $10,000 income monthly, $120,000 a year. How can this person show income to qualify? Jesus Lord. Okay, so how can this person show income to qualify? Well, Chris, I'll let you talk, and then I'll add my little thing on this.
Sure. All right. So basically, we're going to look at the income that they earn, right? And it's right in front of us, $10,000 a month income. So we've already talked about FHA allowing maximum 47% on the front end debt to income ratio. So that tells us we can have a $4,700 mortgage payment, right?
Yeah.
And we just go backwards from there. You just divide up because $4,700 is the max. And then what I use is a factor of 8. And I would just divide that 4,700 by the 8. And that'll tell you what kind of mortgage payment you should have or sale price you should have. But to get you about a $4,700 payment, it's roughly about $580, $575. That's probably going to get you right there at $4,700. So without running numbers, because obviously, I don't want to take all your time running numbers for you, but really quick, I would say that someone making this kind of income with a $4,700 payment is going to be purchasing something right about $575 on an FHA loan.
Okay. So it's just giving people a concept of if you share this income, if you do the minimum, this is what you got. Now there are other programs. There are programs that can add to that. I just heard about 20% share loan where you can get, or you can even get, if you buy in the city of Los Angeles, you can add another 120,000 to whatever you qualify for. So there are different programs that can help you to buy more. So just reach out to us and we can talk more about that. Let's go to case file number 2. So this is an independent contractor. I have a deposit. We kind of talked about this earlier on. They put a deposit of $144,000. So how does this person write off expenses? Okay, so this is actually, I'm really glad I have this case file. I don't even know everything I got in there, but that's cool. So what this is like, okay, you make $144,000. Instead of writing everything like, I get these products, this mileage and all that stuff to write off, where all of a sudden they're bleeding, they're only showing $60,000 in income, right? So tell us, what are the key things? If, let's say, this person have 3 kids, that they are claiming under their stuff, what are the things that they can write off that is not going to affect, it's going to lower their tax base, but it's not going to affect their income?
Right. So, I mean, you really have to get with your accountant, but as Gary is mentioning, you don't have to get as aggressive with your write-offs, because the more write-offs you have, the lower your taxable income, and that's what you want. I totally understand as an independent contractor, just like Gary. But there's a fine line between hurting myself and helping myself, right? Because I'm writing off expenses, and that's good. I don't pay as much in taxes, but by doing that, I'm lowering my taxable income, which is in the same lowering your qualified income. And as we've been talking about, we do need income to qualify for the loans. Now, we don't want to pay taxes, but as Gary has mentioned, if you're paying more in taxes, all that means is that you're taking money out of your savings account for your down payment that you saved. But that's where the state programs come in, and they replenish the monies that you had set aside for the down payment. So you take advantage of the state's funds for your down payment, and then you've got the freed up funds that are in your accounts to pay your taxes. But more to the question of what Gary asked, how much should I write off? That's really kind of between you and your accountant, and you have to understand that once you file your tax returns, they're filed. They're with the IRS. We can't change them. And that's why it's important to meet with your accountant. Look at what your net income is, and then come to us and see, is that qualifying you for what you want? And if not, maybe we go back to the drawing board and not write off as many expenses so that your qualifying income is higher to get you to that level that you want.
All right, so I need you to give us a little more meat, Chris. I know you're a banker, and I get that, but I know I brought files to you before, and you're like, Gary, what is this? Guy just wrote everything up. They could actually have done this and done that. They have these kids, and they could, this. I kind of just wrote off everything. That's kind of the nuggets I'm looking for. Like, okay, let's say this person makes $144,000 in deposit, whatever that may be, right? But they got 4 kids, which is not unusual. People come 4 or 5 kids, or they even have 5 people they're writing off. They're taking care of the mother or father underneath their care, right? So what are the things, instead of writing off all the business expenses, where it gives them a break. You've told me this before, you know, I got, my memory is as sharp as anything. So tell me what that person could have avoided rather than having to kind of write off all these other business expenses.
Yeah, I mean, there's so many expenses that you look at, and I see it all the time on P&Ls, and I understand why they do it. And you know, I don't mean to give you acronyms, but a P&L is a profit and loss that you're going to write for a quarter or for the year, where you then derive your taxable income from. But there are a lot of expenses that you don't have to write off, and maybe shouldn't write off. But it really comes down to making sure that your qualifying income is as high as possible. Because if you truly want to obtain wealth in America, it's by and large, you got to buy a home, and multiple homes, as Gary has mentioned, because that's how you build wealth quickly. You leverage your money that way. But in order for you to do that, you have to make sure your taxable income is as high. So you don't want to write off everything, because writing off everything just lowers your taxable income. Yes, we can get creative, and I do get creative, but it's so, you know, unique to your situation. I have to look at everything, your tax returns, your bank statements, that sort of thing. Because there's programs out there that maybe you don't go full doc if you've got the down payment. We've got them as little as 10% down, Gary, now, where we can do bank statement programs where you don't even have to show your tax returns. We just go off of what you deposit in the bank over the last 12 months, and we use that for your qualifying income. So people who, you know, don't really want to write off, or want to write off, don't want to have to pay as much taxes, we still have solutions for them. But I don't know until I take a look at the file exactly what I can do for them.
Okay. So basically what you are saying is, okay, let's not pay Uncle Sam anything. Come here, if we can see a bank statement for your business and it shows this, you know, $144,000 deposit, we can give that out to you. Now, of course, all of that has to do with, okay, do you have great credit? Is your credit good? Is it over 700? That kind of stuff. These are the many opportunities we have. You know, seek first to explore rather than be silent and thinking this is it and there's no other way, right? It was funny. About 2 years ago, I had a gentleman like, I don't want to pay no taxes. I'm like, okay, cool. And he makes over $500,000. So I'm like, so he said, I'll take whatever, you know, it could, if we put 20% down, which he has, it will save money on interest rate. And he said, no, I just want to put 10% down. I'm like, he said, this is my first house. When I buy that extra $1 million home, I'll come back to you. We'll do what we need to do at that time. I'm like, okay. So it did that. And it's interesting. The interest rate it paid then was at 5.6, which today would be a great interest rate, right? But it's just having clarity that, hey, this is where I want to go, but don't hold yourself back. I mean, I've been blessed. I met a few guys that do work in the car sales business, and these guys make a lot of money, a lot of deposits, and just channeling them to like, this is possible, that's possible. It's getting like 4 or 5 of them to get homes, you know, and they were not thinking of it before, even though they make serious money. I mean, serious money. So please, folks, check this out. You know, comment down. Don't limit yourself that it's not possible. All right, let's get to the next case file because I don't want us to run over. Holy moly, it's 10:52. Okay, this is a Uber driver generating 10,000 a month with 3 kids. How can this person set up their taxes to qualify? Okay, so this person has 3 kids. So obviously, with each child, I think it's $3,000, you know, tax base, you know, for each child. So that's $9,000 right there. You know, what happened is, and I believe I've brought somebody like this to you before, Chris, like, wait a minute, this person have all these kids. They didn't claim, they could have just claimed that. Instead, they want to write off all this business expenses, right? You know, so what can you give clarity to somebody like this that, listen, you already cover for a certain amount, I'm assuming $9,000 already. If you're making $10,000 a month, I mean, that's 120,000. I don't know what that tax base is. It at 10% or 15% at that level?
Well, it would be lower, yeah. I mean, federal, you're probably looking at somewhere around 18% for someone with this kind of income and 3 kids, maybe a little bit less. But to your point, Gary, there's one topic we really haven't talked about, although we dodged it, which is really the taxes and the tax benefits that you get as a homeowner. And I think that's what we need to kind of dive into, because yes, by not claiming or claiming more in expenses, lower your taxable income, you're not qualifying for as much. But you have to understand that once you buy your home, you get certain tax benefits. You can write off the mortgage interest that you pay, and you can write off the property taxes that you pay. And going back to your examples of buying an $800,000 home on that FHA loan, we came up with a mortgage payment roughly about $6,500, correct?
Mhm.
Of that, your tax benefit is probably about $1,200 to $1,300 a month. Each month, think about that. Each month, you're going to get about $1,300 to $1,400 in tax benefit. That's huge, because what that means is that someone who generates that $180,000 in income and doesn't want to pay taxes on it. But can you imagine if you're able to write off now your property taxes at $800,000, which is $10,000 for the year, your mortgage interest that you just wrote on that property of another $40,000. That's $50,000 in lowering your tax base just because you're a homeowner. That's what you want to do, because it's not just buying the house and letting it appreciate, but it's the tax benefits of owning the house once you get into it. So maybe you have to take that hit for that 1 year, Gary, right? Where you pay the taxes for that 1 year, but thereafter, you're going to get the property tax write-off. You're going to get the mortgage interest write-off. You're still going to get the 3 kids write-off. You're still going to get your personal write-offs.
As many people welcome you from Facebook Live. If you join us through Zoom, thank you for coming on. Really excited.